This is the case for Tempest Resorts, and in this case, we're going to take a mixed-up trial balance, which you see on your screen on your left, and create a good form balance sheet. Again, the case is printed. I would suggest in this case that you go ahead and print this case out, and you go ahead and try it on your own before watching the video. And then watch the video if you get stuck or just kind of reconfirm your answer. But this is one that's actually fairly simple, so I think you should give it a go on your own. All right. So what we're going to do is first of all, so I'm always going to walk through my trial balance and start to label these items to figure out where they're going to go on the balance sheet. So my first one is a sales, and I know that's a revenue, so I'm going to just mark these things. That's a revenue. Supplies, this is going to be an asset on the balance sheet, and I'm going to make some assumptions here. Unless I'm otherwise told, I'm going to make the assumptions some of these are short-term or long-term. And they typically, supplies are short-term, but the facts tell me it's also going to be used in May of 2015. So since it's the year end of 2014, we know it's going to be used within a year. So it is short-term. A building, that's also an asset, but that is going to be a long-term asset. Accounts receivable, that is an asset, but it is also short-term. Interest receivable is an asset. We're given the expected to receive in April of 2015, so we can say that's short-term. Treasury stock is an equity account. Accumulated depreciation is an asset account, and it's also long-term, but it's also a contra here. Operating expenses are just that. They're expenses. Interest payable is a liability. And it is short term. Notes receivable, that's an asset. It's expected to be received in June of 2015, so we can say that's short-term. Accounts payable, that's a liability, that's short-term. Common stock, it's an equity. A trademark is an asset, and it's long-term. Equity investments, these are available for sale. So these are an asset. They can either be long-term or short-term, depending on management's classification, but since they have no intention to sell, we're going to say it's a long-term. Prepaid insurance, typically we would assume this is short-term, and the facts tell us that too. Notes payable of 170, this is a liability, and this is both long and short because part of it is going to get paid within next year and part later. Equipment, asset, long-term. Cash, asset, short-term. Unearned revenue, asset, typically short-term, and the facts tell us that also. Allowance for bad debt, this is an asset, it's short-term, and it is also a contra. Retained earnings, it's an equity account. Accumulated depreciation, equipment, it's an asset, it is long-term, and it's a contra account. And land, it's an asset, and it's long-term. Okay? All right, so there's that data. So now I want to start to look at my assets here, and I want to look at the short-term ones. I got a short-term there, I got a short-term here, I got a short-term here. Interest payable, that's a liability. Short-term asset, short-term asset. Short-term asset, short-term asset, short-term, it's a contra, and that's it. So as I'm going through this, let me start to create my balance sheet then. So this is Tempest Resorts. Name of the company always comes first in a good form balance sheet. Excuse me. We're going to say balance sheet here. And and this will be December 31st, 2014. So we're going to list our assets first. And I know that cash is going to come first. So first one I'm going to list is cash. And our cash is, where's it at there? $50. Okay. And that gets a dollar sign. So I can mark through that one. What's going to come next? Typically, I'm going to look for an accounts receivable account because Typically, accounts receivable is always the next one that comes in the list, and this is AR, which is my abbreviation for that. And accounts receivable is 15, right? But the other piece I have in here that's going to be a contra to that is the allowance for bad debt right here, so this 4. Okay, so if I look at the 15 minus the 4, it is 11. So accounts receivable are always reported net of any allowance for bad debt, which is a topic we will be discussing more later. Okay, so what comes next? Well, if I look at my facts and what comes next, it is the interest receivable. So I'm just going to call this interest receivable, and that was $2 because in time, if we looked at everything in a timeline, this is going to come next. So I can mark that one off my list. I can look at my list and timeline, and my supplies are next. Okay, so there's my assets short term. Now, the next one is a notes receivable for $5. That's right here. And the prepaid insurance. And typically you will see prepaids as the last item in the short term. So it's not going to actually generate cash. It's just going to reduce cash outflows. So here's my total current assets. That's $81. Okay. Next, I am going to do my long-term assets, and I am going to start with my equity investments because these are something I can actually turn to cash pretty quickly by just selling these things. So my equity investments long-term are $30. Should I mark these? Should I go through and mark them? So we had that equity investments long-term. That was right here. We have a building. We have this accumulated depreciation on the building. So I'm going to report building and accumulated depreciation on the building net. I also have here my asset, my trademark. Usually trademarks, patents, and other intangibles are reported last as long-term assets. Here's some equipment long-term, my equipment long-term contra. So again, those were reported net. And as assets go, land is usually reported after building and equipment because it has a longer life. All right, so if I look at those items, start to group them up then, I'm going to I generally put my equipment before. I don't think there's any requirement for it. I'm going to say that's net. So I looked at my equipment here of $100, and then my accumulated depreciation on my equipment is $80. So I'm going to report equipment net. Building, I'm going to do the same thing, building net. And so my building is $300, and I have accumulated depreciation on my building of $275. So I'm going to report my building net at $25. So these assets are almost fully depreciated. And I'm going to then show land, and my land is $400. Land on a beach on Vancouver Island on the west side be worth a lot of money, and the intangible asset. So they must have went out and bought this company and paid extra for the intangible asset because you can't internally generate an intangible asset. So I'm then going to report this as my total assets. And if I add that up, that's $646. And I'll double line it. So there's my total assets. The one point I was trying to make here that I got sidetracked on is when generally you do see these assets reported, they're generally reported in how quickly they're going to depreciate. So you'll see equipment net reported first because it depreciates faster, buildings a little bit longer, and then land since it never depreciates. So let's then proceed with our liabilities. Okay. This is getting a little messy. I misspelled that, so ignore that. This is getting a little messy, so I'm gonna change the color here and let's see if we can look at the liability. So interest payable, that's a liability, and I'll put the marks over here on the left of them. Accounts payable, a liability. Notes payable, and remember that one's labeled both short and long term, so we're going to have to unwind what's going on there. And we have some unearned revenue. All right, so we have basically those 4 accounts. When we generally think about liabilities, accounts payable generally comes first. So I'm going to abbreviate that accounts payable, and that will be $45. I think the facts tell us that interest, looking at the facts, I think interest payable will come next. Spelled it wrong, sorry. Payable of 13. And then the unearned revenue will come next. And that's at 120. And the last item is notes payable. So if we look at the notes payable, there's 2 things we need to focus in on this. And that is that it says $100 is due April 2015. The rest is due in May 2016. So we have $100 of notes payable. That should be considered short term. Okay, so here's my total current liabilities. And that total is $278. Okay. And then we're going to show, then we would have the only other liability we have left is the notes payable long term. And those are required to be reported separately. And since it's 170 and 100 is reported as short term, we have 70 left over. And so we're going to show total liabilities then of $348. Okay. Then we're going to do our equity section. We're getting close to wrapping this thing up. What accounts do we have we need to look at? Well, we need to look at the treasury stock. We need to look at, let me get rid of some of these here. So this interest payable we took care of. This accounts payable we took care of. What are we left with here? So we're left with the common stock, the trademark, the equity, the prepaid, the notes payable, the equipment, the cash, the allowance for bad debt, the unearned revenue, the retained earnings. So we're really looking at here is this treasury stock account here, this common stock account, these operating cents and sales revenue, and this retained earnings. So let's first do the common stock. That's the easy one. So our common stock account has 140 in it, and we'll just put that right there. The next account typically is, you're going to see in here is retained earnings, although there's no set order. Now, the one thing you have to do with the retained earnings account, because it's reported this 192, you can't just bring this over there because it won't balance. You have to take into account the revenues. So we have 192, and if you look at it, it's a debit balance. So it's a negative balance to begin with, okay? Because it was a debit column. It's in the debit column. We also need to add in $6,000 of revenue. And if you notice, that's a credit column, so we can add that. And then we'll subtract out the expenses of $5,500. So if we add all these up, we're going to come up with a retained earnings of $308. Okay, so there's the 308. Treasury stock. We can talk about what treasury stock is in class. Treasury stock, we're going to record this as it's a negative because it's stock you've bought back of your own company, and that's $150. So our total equity then is, so total equity is $298. So then if we do a total liabilities and equity, we get a total of, I believe, $646, and we're happy because the balance sheet does balance. There's one last little piece in here that I didn't leave any room, but I'm going to show you one thing that I'm going to require you to do on the common stock account. This is always required on the balance sheet. You always have to start to indicate the number of shares authorized, issued, and outstanding. Okay? So in this case, the company has 1,000 shares authorized. They have 100 shares issued. And they have, in this case, 80 shares outstanding. And that is, you will, if any balance sheet you look at, they will always report this information. Okay, so this is something I'm on a formalized good form balance sheet I'm going to require you to put in here. Authorizes the number of shares they can sell on the market under the corporate charter. The number of shares issued is the number of shares they actually have sold on the open market. And the number of shares outstanding is the number of shares issued minus any treasury shares they have purchased. And if you look at the facts, they have purchased 20 shares back, and that's that 150 negative. So the number of shares outstanding is 100 minus this 20, or 80. Okay, so here is the good form balance sheet for Tempest Resorts.